Hey everybody, welcome back to another beautiful day in real estate. I'm actually really excited to dive into things today. We're going to talk a little bit about the credit crisis. We're going to talk about oil. We're going to talk about the war in Iran. And then at the end of the video, after we've talked through all the craziness, we're going to talk about some optimism into 2026 of Q2. So first off, interest rates, you guys. Interest rates are still below the 6.5s and below the 6s for FHAs and VAs on average. This is good news. This is good stuff, right? Means interest rates aren't moving a lot. And again, I show these every day. They don't move significantly every day, but it shows that my point is to kind of showcase, all right, this is how much things move. It's a slower transition. And right now, even with the war in Iran, things have stayed pretty significantly even. And that's kind of crazy to see, right? But interest rates are not terrible. They're not great. So we'll keep moving forward. Oil is our next topic of conversation. You guys, oil has been... It's waiting to see what happens because they announced that J.D. Vance is going over, I believe, to Pakistan for a mediated negotiation with Iran. The ceasefire really hasn't been a ceasefire. Israel's still shooting missiles on Lebanon, claiming that it wasn't a part of the ceasefire. The United States is telling Israel, chill, bro. So everything's kind of staying weird, but oil hasn't really moved. It's waiting for the next big move with this war. Now, with this war, the most interesting thing is the Strait of Hormuz was not opened as initially promised, right? So the United States is saying that it was supposed to be open. Iran's saying it's closed, right? Only one tanker made its way through yesterday. That's out of the, I don't know, it was like 173 tankers or some crazy number like that, still sitting there just waiting, full of oil to get out of there. But Iran came out with something that's a little fascinating, to me at least. And it's not good, it's not bad. Again, I don't take sides, I just bring the information, right? But they said that they want to create a toll to transfer oil through the Strait of Hormuz. Like basically they said they want $1 a barrel, right? And they want it in either cryptocurrency Bitcoin or they want it in yuan. That's kind of an interesting topic all in itself, right? Because we've never seen tolls in international waters before. This is like a proposal that I've just never, I guess I never would have expected. And then Trump comes out and he's like, well, I mean, that doesn't sound like a bad idea as long as we can get a piece of it. So even the United States is open to it. It's kind of a weird concept, right? But everything's still shut down. They said they're not going to open up the Strait of Hormuz until there becomes some sort of agreement to end the war, which is crazy to me because even though we're in a ceasefire quotation, and I mean, we're not really in a ceasefire. The missiles are still getting shot. Armies are still moving. It's unfortunate. But anyhow, so that's why we saw a ceasefire deal, oil tanked. And then they're like, Strait of Hormuz is opened, tanked. And they're like, nope, no, it's not. So it got bought back up. They started moving up and they said, now we're in negotiations. So it came back down. Like the consolidation between 101 and 92 a barrel for crude is just kind of as we anticipated. Again, I use 1 day candles. I like to anticipate the next 3 days. And the next 3 days, I think we're going to see consolidation. I don't really see a move upwards or downwards, depending on what happens in the negotiations here in the next couple of days. We'll find out. They're supposed to go today. So we'll know this afternoon what's actually going on. But for now, transitioning over to CPI, we're going to talk about CPI a little bit. So the two-year bond, or 2 year, that's the 1 year. There we go. 2 year actually went up slightly this morning on market open. It opened at 3.7 or 3.78, 3.75, 3.78, excuse me. And we're still in that kind of consolidation. So we talked about this yesterday, but as of right now, it looks like we're going to be in that 4.27 to 4.4 range. Again, consolidation until we see big numbers changing things. The CPI inflation wasn't great, but it wasn't terrible, right? CPI numbers. Basically, we saw a 0.3% month-over-month growth, bringing to an annual rate of 2.8. Core inflation, this is headline CPI, right? And then core inflation excluding food and energy is up 0.4, bringing to a 3.1 annual pace. So again, not a huge move, not great. The Fed still wants to see a target of 2% before they start lowering interest rates again. They've said that before. So basically what this means is that it says for my audience, because I love using Claude to kind of help direct my information, because I can be all over the place, as you guys may know. The bond market immediate reaction yields are up, stocks are down, and the most important signal, higher 2 year yields on the 2 year bond push to the 10 year higher, which the 10 year correlates the mortgage rates, right? and then this print doesn't move us closer to relief on that front. So basically, we shouldn't be expecting to see inflation go down, or we shouldn't be expecting to see interest rates go down. They brought down the probability of a rate cut in June from 55 to 35%. The CMA, that's the futures trading exchange out of Chicago. But anyhow, so we're kind of not anticipating any of that. There's conversations that we might not see another rate cut in 2026, which is very possible, right? Like nothing's really good, nothing's really bad. I mean, inflation is trickling up. It's nowhere near as quick as it was in 22 and 23 because we had all that money being printed during COVID. But anyways, so again, we're just going to touch on the inflation. So CPI inflation rose to 3.3%. This is in total year over year, right? And then below expectations of 3.4. Core inflation 2.6, expectations 2.7. So it rose, but it didn't rise as much. Now up the highest level. CPI inflation is now up the highest level since May of 2024 amid the Iran war. Fed rate cuts have been priced out for 2026. So again, until inflation can kind of see its thing level out and go down, which I just don't see happening, even though the job market's weakening, even though we have a war in Iran. Inflation right now, we still have a lot of things that are uncertain, and we have tolls and taxes and trade deals, and there's just too much stuff to really anticipate interest rates going down. Again, I think it's just going to stay in the low or the high fives for the FHA and VA and the low sixes for conventional all the way through 2026. It just doesn't make sense to see anything else change unless I'm missing something, right? U.S. energy inflation soars to 10.9% in March, the biggest increase since 2005. So we're starting to see more inflation on different sectors, right? Again, we'll keep it a close eye on it, but 10% is a pretty big move in energy. That means that your electric bill, your gas bill are all going up, which also means that if you're a company that delivers products, so you're a trucking company, obviously it costs you more for diesel, right? So now you're charging more for that as well. Things are getting more expensive, and I mean things don't really get less expensive over time. We've kind of known that. That's why it's so valuable to understand it's valuable to understand what investing can do for you. Every other Friday I get paid, and every other Friday I put money into a savings account, I put money into an investment account, and I put money aside for another investment because for me, dude, I don't get me wrong, I live pretty comfortably, but I also make sure that every single Friday or every other Friday I am putting money into an account. I have a set amount that gets invested every single month, no matter what the bills are, no matter what. And people think, well, that's hard to do. Honestly, once you start putting it in your budget, it's really not that hard to correlate and work with. But anyhow, so now we're going to talk about private credit once again, right, guys? So we've been talking about the private credit market and how many issues we've seen, potential issues. It says private credit seems to be in big trouble, and the reason is because withdrawals have spiked at private credit funds, redemption requests, non-traded BDCs. This is $1 billion, right? So I didn't read this correctly, but that's okay. Basically, it's just showing a big gap of unmet redemptions that are requested right now. We talked about that. Companies don't have the liquidity to pay for the private credit request because they leveraged the money, and now the money's no longer there. And again, we talked about it yesterday. It's kind of crazy how in 2008 is when they actually created these private equity funds. Post 2008, so post the financial crisis, they created a different program, basically put a different label on it, and continue to do the leveraging BS they did before. The only difference now, and this is one that I'm going to really harp on, the banks aren't holding the bag in this case. This is the pension funds, this is the 401k funds. This is your money that they leveraged, and you're the one that's going to get eaten up on this. Me personally, I don't believe in 401ks. I don't believe in Roth IRAs. My wife has a Roth IRA, and we invest in it, but it's not my main source of investment because I don't know where that money's invested. And they leverage your money. They do. And I mean, as much as you want to say it's safe and the average return is this and that, I just don't trust them. I'm a big proponent of understanding where all my money goes, because people don't take things seriously. They don't when it comes to other people's money. They'll leverage, they'll risk it. They don't care what happens. They don't mind if the market crashes because it's not their money, right? Anyhow, so another private credit gate slams down. Carlyle private credit fund hit with redemption requests totaling 15%. As we know, Blue Owl Capital, as we know, Morgan Stanley, BlackRock, Blackstone, all of them had the same amount or very similar 15 and 16% requests. And they all capped at 5%, that were actually able to pull their money out. So of that 15%, 10% of that money is still locked up. They can't pull that money. Again, not a good sign. Not a good sign at all. Things are going to be looking a little bit more. Again, it's just the cracks keep getting bigger, and the realization that we are kind of have to we have to focus on is there's a good chance that there's a good chance that this is going to be the driving factor that could crash the market in the next few years. And I think a lot of people, and the whole purpose is liquidity issues, right? So put your tinfoil hat on for a second. Again, believing in an upgraded financial system that needs seamless transactions creates the liquidity, right? This, in my opinion, could just be the beginning of the big transition, if you will, to a new system. Because you see other influencers and they talk about the financial system and there's a switch being flipped. Like it's not an overnight process, right? Like it's going to happen over time, and they create a problem so they can create the solution so they can transition, right? The problem, in my opinion, could have been and probably was planned from 2008 moving forward. Remember, Bitcoin was the inception of Bitcoin was 2009, right after the financial crisis. The point of Bitcoin is to create a limited asset that increases in value year to date, right? And on average, it does. The point of cryptocurrency that followed was seamless transactions and digitalizing assets and being able to settle transactions in minutes rather than days. Like, to me, it all makes sense that we're kind of following the plan, right? I think 2030 still is going to be that time frame where we're going to be in a different world. It's going to be at a different economy. We're no longer, like, AI is creating more seamless workflow so that you don't need so many people per company, but companies now can scale so much quicker. And also it leaves the opportunity for more people with less resources to create companies. I'm going to bring it up again. A buddy of mine built a company in a couple of weeks that was a software company that was able to, that you can pay for a subscription to track your data on healthcare systems, things like that, to see if you're in compliance with all the rules and regulations and laws. Like that took them a couple weeks to establish a software system like that, right? So we're optimizing, AI optimizes our workflow, right? So everything's different and it's transitioning, and people are pointing at the cracks as if they're kind of hunkering down the hatches and waiting for this big implosion of chaos. But really, it's just the next step forward, and we're all too scared to move our money into these things because they're speculative, and headlines say that it's not a good investment. Dude, I invest every single day in Bitcoin. Literally, I used to buy a pack of cigarettes for $5 a day. Granted, this was like 8-10 years ago, but I decided that I was going to buy a pack of cigarettes. Granted, they're $10 a pack now, which is nuts, but $5 a day. Just put $5 a day in there. That's $150 a month. I put $150 a month in my investment, and that's my daily investment. I have my weekly, bi-weekly, and monthly investments as well. But I mean, it makes sense to me where everything is being upgraded, right? I mean, Amazon's a big one, right? That was the big upgrade for shopping. You used to be able to, you used to have to go to a store to purchase product, and then you have to order through the store and stuff. Now Amazon provides the ability for you to order anything you absolutely need. Dude, I can order literally anything on Amazon and have it dropped off at my doorstep. If I want peanut butter, I can have peanut butter dropped off. If I need soap, hair gel, if I need, it doesn't matter what it could be, car parts, dude, anything can be dropped off on my doorstep, and all I have to do is to send my phone, right? So that was a huge upgrade system for retail, right? And then we talk about credit cards. That was a transition over time. That was, again, back in the early 2000s, but again, people said I'll never use it, they didn't trust it, and now everybody has a credit card, everybody has a debit card, and now companies are not taking cash anymore, right? So we use Apple Pay, we use Google Pay. That's, again, more of a blockchain. It's a digital wallet is what it is, right? They talk about digital IDs coming out. Like, there's so many things pointing to progression in technology, progression in the economy, progression in growth, progression in money systems. But we're all too scared because we see headlines like this and we're all just like, oh my God, housing's going to crash and interest rates are high. And we're all looking at here and now, but we're not factoring in 10 years down the line. And we sure as shit are not planning for it. But anyways, that's my whole spiel on that today. So anyways, next thing you guys that we're going to talk about is housing. So in housing, No Limit. I don't know if you guys follow him on X, but he's actually pretty interesting cat. But he's obviously a very big doom and gloomer. He's talking about the world ending, and well, I shouldn't say that, the world ending, but he's anticipating a major crash. And one thing he posted, February home sellers cut prices at record rates. So just saying that 34% of homes listed were taking rate cuts, or taking price cuts on their home. I mean, we're doing it in ours right now. I mean, it's not something that's extremely not common. But again, I'm still going to point you 2021 to 2022, right? 2020, the times where we had low interest rates and homes got overly inflated. Like, to me, this makes sense, right? It doesn't mean that the market's crashing, but it does make sense to me because interest rates are double what they were 3 years ago. People can no longer afford these homes at a significant rate, and they're looking for deals. Even though the inventory's short, I mean, we're still seeing people out there buying, but their buying power is significantly less. So people aren't willing to overpay for homes anymore, and the market's kind of leveling out and becoming more neutral for the first time since before COVID. So again, I get that a lot of people are dropping prices, but I also think that a shit ton of realtors and a shit ton of sellers still thought that the homes are valued at so much money. And I looked in the mirror this year and I was like, dude, let's be honest with these people instead of bullshitting them. When we're listing homes at the correct market value now. Last year we were a little high in some of our homes, and now we're listing with correcting. Now guess what? We're getting showings, we're getting offers, and things are moving, right? So I don't see that as a factor that's really going to ruin the market. Again, I still think that private credit, I still think that credit cards, and I still think that auto debt is going to be the big thing that's going to push the economy negative. And that will trickle into the real estate market, but I don't think real estate is going to be the major crash that everybody's anticipating. I am confident that it's going to be private credit, and that private credit might be the reason they transition to blockchain and seamless transactions. Really, they might come back at the end of this crash in the next 2 years, 3 years, moving into 2030 and saying, you know what, we don't want this to happen again. So here's the solution. And everybody's going to jump for joy because they're all going to be hurting way more than they're hurting now. I don't think people are ready for what's going to happen. I still think that the market's got a lot worse, going to get a lot worse before it gets a lot better. But on that note, let's move into some positivity, you guys. So mortgage rates ticked down this week. Freddie Mac's chief economist said this, and the 30-year fixed mortgage rate went from average 6.37 as of Thursday, down from 6.4 from last week. The decrease in the rates represents a positive development for prospective home buyers and could spark a favorable spring buying season. More than last year is essentially what they're saying, right? So you guys, like I told you, I think we're moving into a normal spring market. So this is just kind of confirming it to me, right? Interest rates aren't running to the sevens as everybody panicked about in February and March when the war started. They're not moving down, but they're also not moving up. You still have opportunity to get into a house. All you have to kind of do is start moving on the right direction, right? It's spring, you guys. I'm already seeing, I mean, it's after Easter. I'm doing open houses all weekend this weekend, and I have a client who's ready to go jump on some more houses. We've got more listings coming up. I mean, builds are getting ready, more building opportunities. People are still want to buy homes. They're getting used to the new normal again. We're getting out of the 3% interest rates. Like, they're ready. They're ready for it, right? Anyhow, insiders have not turned bearish. Oh, let's put this on the screen, actually. So the next thing, insiders have not turned bearish despite the Iran war. 26.4% of the U.S. publicly traded companies saw net insider purchases in March, the highest in 5 months. This reading is up 20% in February and marks the second consecutive monthly increase. This is also above the 10-year average of 23.5. Perfect. The corporate executives stepped in to purchase their own stock after the market pullback last month, a signal of confidence and recovery. So again, we're kind of in that part of the market where we're seeing a up and down, right? So meanwhile, the energy sector, the proportion of companies with net insider purchases fell 1.6% to 17.5%, suggesting insiders do not expect oil prices to stay elevated for long. Again, the oil market's kind of telling us that, right? I mean, we're seeing a little bit of buy pressure and a little bit of sell pressure, but we're not really seeing a major amount. I think people are waiting for some sort of decision here before they move forward. But again, that's why we have to pay attention to this stuff, because there's so much more that goes into this that, dude, I didn't even scratch the surface of what I was looking at this morning, because there's so many different things, right? Um, I think the important thing in this video is that, dude, my whole point of this video is like, look at everything. Stop looking at just one thing, because we get honed in on one thing and then we think that's going to be the deciding factor that's going to crash the market, that's going to move the market. We're going to see interest rates, whatever. But there's a whole lot that goes into it. There's still good things on the outside that we need to be paying attention to. We'll dive more into this stuff tomorrow. Again, I know we've kind of reached our time, but thanks for watching, you guys. I hope you have a great day, and we'll see you soon.